Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts for the Week for May 3rd of 2021. Please share a disclaimer for important information. In our COVID tracker for the week, we are beginning to see a pronounced decline in the 7-day moving average of daily new positives. You can see that we talked about this last week and it looked like a trend was forming, and this week's data actually does confirm that we're seeing that, along with the continued attenuation in the 7-day moving average of daily deaths. The chart from the Economist magazine, which highlights in mostly the kind of the green and light blue colors. The rest of the world is experiencing a downtrend, more or less, due to vaccination in coronavirus cases. Now, what's been in the news lately is what you see there in that lighter color, and that's India. India has clearly had an outbreak. Obviously, there's a socioeconomic divide in India, a lot of undeveloped rural areas of India that don't have access to the vaccine, and so they're seeing, frankly, it's kind of a humanitarian crisis right now in India, and you can see the influence on the rest of the world. But by and large, outside of that, rest of Asia, in Europe, here in the U.S., beginning to see very positive trends on the coronavirus. Here's our breakdown by type. As we know, Johnson & Johnson was reapproved or reauthorized after that brief pause to investigate those cases. So now we're up to about 8.1 million doses of the one-shot J&J. And if we look at Pfizer, BioNTech, and Moderna together and add in the Johnson & Johnson, we're about 235 million doses. So we're well on our way. As we have speculated for several months now, that with the advent and rollout of the vaccines, that we'll be able to put a shot in every arm, and in some cases here with Pfizer and Moderna, we can put the 2 shots in every arm that wants one by the end of this month. Here's our high frequency data. Comes to us by way of First Trust. And First Trust is kind of augmented, I guess, a little bit of what they produce for us. And you can see here in this data, the change month over month and the change week over week. The data remains by and large fairly positive. We did have a slight decline in the latest week for commercial flights, but nothing that gives me a great cause for concern. We've got a lot of individual breakout items here to show you in just a couple minutes, but if you look at open table, restaurant industry, very symptomatic of an economy that by and large is opening, broadly speaking. Steel production looks good. Hotel occupancy down just a little bit, but that tends to be a little bit lumpier as you kind of get around vacation periods and things like that. But box office receipts is really more of a function of movies that are available right now, and you're beginning to hear more chatter, studios planning releases and kind of thinking proactively about getting movies into theaters before they do put them on streaming. But staffing, employment, all trending in a positive way. Here's a brief look at the airline industry. So on the right-hand side is TSA checkpoint data. You can see on both charts, 2019 is kind of in gray, 2020 is in orange, and 2021 is in blue. And you can see where we picked up at the end of 2020 with TSA checkpoint data and commercial flight availability, both moving slightly higher. And thus far here as we enter the month of May, you can see in both cases they're below, the number of flights is below where they were in 2019, but picking up. And also TSA checkpoint data is picking up as well by and large. And just anecdotally, I was on an airplane, several airplanes last week, and I can tell you that my flights were completely full, with one exception, but the airports had more folks. TSA checkpoints were not terribly crowded, but there were a lot of people in the airport. A quick view of open tables, restaurant reservations, as well as hotel occupancy. You can see this recovery. The orange line was represented last year, and we continue to perk up on the restaurant side. You can see the latest data point that we have represented a nice uptick, getting back to our interim highs, which we saw last month, as well as hotel occupancy. We're seeing trends that still fall below 2019, but they're getting ever so closer to that recovery point, and do think it's going to take a while before we actually reattain those prior levels, but the trend line is certainly favorable for it to do so here, perhaps in the next 12 months. Steel production is something, we don't focus a whole lot on. Rail car traffic, we don't focus on that necessarily either, but we know that durable goods orders have been really strong. We know consumer demand for goods has been very strong. We know that we've seen a global pickup in trade. We've got charts on all of that. But clearly here, steel production we know is up. It's still below where we were in 2019, but it's tracking at a favorable level. It seems to be, certainly moving in the right direction. Rail car traffic, we know that that's been strong, and frankly, we're above the levels that we had in 2019. Again, the case where demand has picked up a lot faster and a lot stronger than most people thought it would, and that's been very favorable for these two segments. Supply of motor gasoline, we are recovering very nicely in this area as well. You can see the recovery in orange off the trough, and then we rolled over a little bit towards the end of the year when we typically don't get necessarily as much driving per se, but here as we enter the peak driving season, we're getting really, really close to those 2019 levels, so pretty encouraging on this front. Our next slide here is from the Conference Board, and it's the U.S. Economic Leading Indicator Index. You can see here that we've recovered very nicely. We watched this for signs of rolling over, and you've got two different bars here. One that's been adjusted to show the trend lines based on peaks, and one that's been shown to kind of take off some of the peaks, like the dot-com bubble, the credit and housing bubble during the great financial crisis. And if you smooth this out to kind of take away the peaks and the large valleys, then where we are now is basically really close to where we were in 2019, which was certainly positive in just about every respect. We've recovered nicely. This has a lot of bullish overtones here because of all the things that go into it. And these are really reflective of high frequency data, in terms of production, orders, things like that. Obviously, the stock market has an influence on the leading economic indicator index, and so just another positive data point for us to reference here. We'll talk about GDP growth here for a little bit, and so this number that we've seen, at least the first iteration of it, is very strong. And it's the strongest that we've seen in quite some time. If you go back on, basically this annualized basis, you've got to go back a long way to get close to where we are. And we knew that this number was going to be great. It's building off the trough. There's a lot of influences here. Inventory building, consumer spending was very strong in the month of March. Just a reopening of the economy, and as well as the expansion of global trade. So as we look here, I certainly don't expect this going forward. Just the law of averages is just simply not on our side here. But having said that, I think it's a great launch pad for the rest of 2021, even if that growth rate begins to fall a little bit. Now here's some breakdown of that number. You can see it and kind of depicted in more of a near-term basis. If we look back over the last handful of years, you can see 19.1 trillion is where we are. So we're not quite back up to where we were at the end of 2019, but we're getting very close, and we're kind of reattaining that trend line, multi-year trend line that we've seen here. Now on the right-hand side, we have contribution to real GDP by sector, and you can see here, without spending too much time looking at this chart, you can tell that the strong impetus here on that last line on the right. The last bar is that gray area, and that's consumer spending. We had a very strong consumer spending uh, data point for the month of March, and that was coming off some momentum in February as well. So we had inventories that in this case, in this particular month, were a little bit of a drag, and net exports continue to be a drag. As our trade deficit continues to widen, even if global trade is picking up. Now here's our inflation-adjusted GDP. You can see here that we've got a near-term line in red with a projection over the next several months, quarters, and you can see here that we've not quite reattained where we were, but if this index is back to pre-recession or pre-recession peak, you can see that the impetus there is to get back fairly quickly. Now that's juxtaposed against this blue line, which happens to be the global financial crisis and the recovery which ensued from that. And you can see that the recovery period in overall economic activity took much, much longer than it's taking right now. In this case, we're talking literally a matter of months to perhaps even a year and a half at the latest here. But back in 2009 and into 2011, you can see that it took many more years and much longer to retrace its former peak. On the right-hand side, you see another depiction from Oxford Economics, which shows you here in first quarter of 2001. Obviously we've had a nice pickup, and you can kind of see how, at least in this one particular iteration, how that recovery path looks. And in this particular analysis, it shows that by the time we get to the third, basically about the fourth quarter of this year, we're going to actually exceed that prior, what they're calling a pre-virus path. And so we're essentially within 15 to 18 months of this pandemic, going to completely recover all of our lost economic growth, despite the fact that we've had a lot of losses in small business, despite that we have a higher unemployment rate than we had going into this. We are recovering a lot of jobs, but it's going to take time. But a rather interesting analysis here by Oxford showing that we're going to basically recover that lost ground by the end of this year. There's a quick look at inventories, and I just said that inventories were a bit of a drag, and that typically comes from the retail side of the ledger. You can see here you've got wholesale inventories month over month, which continue to be positive, and then retail inventories, which are being drawn down. So we know that there's going to be likely some more inventory activity on the retail side, but it's going to take time, because what's not being really reflected in here is you have items in various stages of production on the left-hand side, which are wholesaler inventories. And then those have to be fabricated and then delivered to the retail locations there on the right. And we know that we've got supply chain issues which are still apparent. We certainly, all of those items that need semiconductors, we know that there's a global shortage of that right now that'll take some time to work itself through. So this situation, conundrum, if you will, is likely to persist for some time, where you get a buildup in wholesaler inventories, but you're still struggling for inventory at the retail side. You see this with consumer electronics. You see this in some cases with appliances that require semiconductors. I know some people are complaining about having to wait months for dishwashers and washer dryer combos and things like that. We also know that the automotive industry is impacted by this, and the automotive the auto numbers are embedded in this in these charts here. So I'd say autos have actually had a pretty meaningful impact on this data. Here's our trade deficit, if you will. It's kind of an ugly looking chart, and what it shows you is that bottom line is that we are importing a lot more than we are exporting right now, even if global trade is picking up. You can see our trade in goods. Now, this is not our services. Now, we typically look a lot better in our trade deficit when it comes to services, because we have become much more of a service economy. So we tend to export more services than we certainly do goods that are manufactured here in the U.S. But you can see here that the consumer demand has really played a big part in this. Consumers have come out or come through this pandemic with a healthy appetite for durable goods, and that's manifested here in these numbers, which continue to go down in terms of the net trade balance. Well, here's a positive data point. We've been tracking sentiment at the corporate level for some time, and we know CEOs, even during the heart of the pandemic, were by and large positive over the long haul. And as I always say on these broadcasts here, that it's not what they say, it's what they do. But you can see here that business investment has picked up. There was a clear rebound from the trough, but it's still positive, and positive in a way that exceeds levels that we've seen in prior years. So it's a very positive takeaway that businesses are standing behind this. Now, they're not putting it into structures, which is what you see on the right-hand side. They're not building brick and mortar necessarily, but they are putting more investment into equipment as well as developing intellectual property, which has a productivity shelf life, if you will. It also has the ability to generate incremental revenue from licensing and things like that. So clearly, businesses are gearing up for incremental capacity and incremental productivity even if they're not investing in structures per se. And this is a consumer number that I think really just kind of outlines and highlights some of the issues that we've been talking about in the prior slides. Now, you see services haven't picked up, and that's just a function of the fact that some areas of the country are not as open as others, and some are still operating at limited capacity in some respects. But goods that can be shipped, drop shipped, and Amazoned, and FedEx, so on and so forth, those numbers look really, really profound and continue to move up. And this is where all the strength in consumer spending is right now. When we get into 2022, would expect to see that services number really begin to rocket higher, and then maybe the goods number begin to slow down a little bit, just owing to the base effects of the law of large numbers. But clearly you can see here that goods are driving the ship, if you will, right now. This chart really speaks to the kind of the tough spot that we're at with the U.S. dollar. Last year we witnessed a dollar decline of some measure. This year we've seen the dollar kind of pick up in value. And you've got two charts here that argue on both sides of the dollar case. So on the left-hand side, then you obviously have the relative outperformance, economic outperformance of the U.S. versus the rest of the G8, G9 countries, and that clearly is outpacing, right? The U.S. is recovering. There's a lot of other areas like Europe that are, had struggled out of the gate with the vaccines, and so less robust economic growth. And U.S. typically leads the world in an economic recovery by some months, and so we're seeing that right now. And that blue line is pretty impressive. But you see the correlation between that relative outperformance by the U.S. and the dollar index, which is noted here in this dark blue as the DXY index. And so that's lagged, and that you can see what I talked about on the outset of this slide is that we had decline last year. We've had a little bit of a pickup this year, but kind of settling out. This chart would clearly argue that the dollar is undervalued and the dollar is going to pick up steam and follow this trend line that's being set by U.S. relative outperformance. Now, if you look on the right-hand side, data that comes to us by way of BCA research out of Montreal, and you see that with all of the stimulus and the asset purchases by the Federal Reserve, this overly accommodative stance that the Federal Reserve has, that it would tend to argue for a weaker dollar in this case, right? Because we're in many respects kind of almost debasing the currency by printing money. But so these two forces are at odds with one another. So you can see the correlation in the right-hand chart, with periods of significant, significant, easing and and economic conditions against the dollar real effective exchange rate, and you see where you would expect the dollar to follow this line down. So we live in unprecedented times, clearly, and what this chart just really highlights is the fact that you've got two very compelling forces that are kind of fighting against each other. And I think the net of this is that the dollar doesn't necessarily move that much. And this has ramifications, kind of broadly speaking, in a lot of areas. You've got 40% of the S&P 500 earnings that are sourced from abroad. Now, if you have a weak dollar, that's that's good for exporters because they'll export more. It tends to be better for commodities. Then the opposite is true if you have a strong dollar. But then you've also got the issue for all those S&P 500 companies of translating. If you have a trending dollar that's moving lower, then obviously you've got the issue of translated earnings back to the home currency, if you will. We've benefited from having a weak dollar in the S&P 500 last year, and I do think that the dollar kind of almost, these two forces kind of cancel themselves out, and so we're in what I think is going to be an okay place for the dollar over the next 9 to 12 months. Now for a quick conversation on the labor market. On the left-hand side, you can see initial jobless claims, and on the right-hand side, you see continuing claims, and these are ongoing claims that basically, I think, show the real health of the labor economy here, and you can see that number continues to come down. Both these charts look very similar, but again, the one on the left represents this initial claims. These are new claims for unemployment insurance, and after the peak, we've seen a continual downtick through December. We had just an ever so slight kind of taking a step back, if you will, in the progress being made in the labor market, but it's continued a downward trend as we look at that blue line heading into 2021. And the same thing's going on with continuing claims. Now we know that there's embedded in all of this is your traditional state claims, the ones that we're used to seeing and that we have data points on, dating back a long time. Now, on top of that are, what are these pandemic unemployment assistance, these very unique, different kind of, special claims and special benefits that people are applying for and getting. So the PUAs continue to trend down, but they still are at an elevated level because there's still obviously a lot of people that are displaced. But the one thing that's not as apparent in these numbers is that the state claims are going down at a faster pace. So as we get to more reopenings, and we know that there's a lot of areas there's actually labor shortages. So would expect the labor economy to continue to pick up, especially as we cycle out of and past some of these pandemic unemployment assistance programs. Now here's a chart on world trade that I've been referencing. Even if our trade deficit is going higher, I mean, this is something that you want to pay attention to, and from a global health standpoint, and from you don't want the U.S. to be the only ship that's moving in the right direction. You want basically the global backdrop to be moving in synchronization, and that's beginning to happen here. So after several years, frankly, of rather sluggish trade growth, and a lot of that had to do with some of these trade barriers and these protectionist trade policies that were put in place not only by the Trump administration, but a lot of other governments in retaliation. And then we had a rather cratering in net trade last year for all the obvious reasons. We're seeing a pretty strong recovery, and you've got to go back a long time, actually, beginning of the most recent economic expansion cycle to find levels of net trade growth that we are seeing right now. And essentially, from a global trade standpoint, we've reattained those prior peak levels, which is very positive, I think, from that. From the standpoint and the argument of the global recovery that we've been talking about for several months now. A quick comment here on the S&P 500. We're in the midst, kind of in the latter half, I guess, if you will, of the S&P 500 first quarter earnings reporting season. And what you can see here is that the proportion of the S&P 500 that are beating their earnings estimates is at its highest percentage level in a long time. And that actually comes on the backdrop of the fact that the estimates entering the quarter were continually raised, which is very typical. So when you say like first quarter earnings are generally reported between April 15th and May 15th, and the estimates that you have at the beginning of the year before you get to that earnings period tend to go up. That's very typical. Analysts begin to revise their earnings up and up. And so we had that this quarter, but even still, even with those earnings estimates being raised heading into the reporting season, we're still witnessing a pretty profound beat. So this is giving a little bit of extra wind behind the sails for valuations. What it's also doing is it's actually reducing the net multiple in the market, the price to earnings multiple in the market, because prices haven't responded as robustly as earnings have. And so you're actually seeing a little bit of multiple compression, which is very ironic. But this is very healthy for the market, and especially the fact that you're seeing it, broadly speaking, amongst a wide variety of companies, not just a handful or just a few. Cash dividends moving higher. Not much to say here other than we expected this, and we're seeing it. We're not to prior peak levels quite yet, but it's good to see companies as they're making money, they're distributing more to shareholders. So a quick comment on housing. I don't think these charts are going to surprise anybody. We have had in the most recent data point here, data that comes to us from Bank of America, 17% year-over-year gain in U.S. house prices, and that's the highest level that we've ever seen. I saw several different charts on this coming from Federal Reserve banks, from other research houses. They're all really pointing at the same issue here, is that this is not a regional thing. A lot of people belly aching over opening their property tax appraisal statements, but there's very few places that you can go that don't have home price appreciation of a meaningful sort right now, and we're operating from a deficit, and that's why home builder optimism surveys are really high. New buyer activity surveys are really high, but the supply of homes is not keeping pace with that. And the supply of inventory in the market, which is represented in the right-hand chart, continues to decline. As messy as this is, basically the lines go from low dollar value houses all the way up to high dollar value houses. The issue is the same. The trends are the same. Inventory is now down at 1.1 months, and a healthy market is generally about 5 months. And so we're really constrained on housing stock right now. And it's not a regional issue, it's a national one. So here is another chart which kind of puts something else in perspective that we're going to have to watch here, because we know that for the average household, the majority of their net worth is tied up in their house. And so the mobility factor is at play here, because what you're seeing is that home prices are outpacing average hourly earnings, which home prices are in this kind of purplish line, and then average hourly earnings is in the red line. You can see where that's really picked up. Now, not just to be fair, this is not something that just happened over the last year. This has been a trend that's been in the making for several years. But when you think about it in context, that you have housing affordability with income that's not keeping pace with prices, it makes it harder for people to get into houses, even though rates are exceptionally low right now. Another quick comment here on commodities, and this is the Bloomberg Commodities Index, and it captures a wide basket. I know I've shown a lot of different charts on commodities, and a lot of them are looking the same. Whether they're the soft commodities, you've got cotton, textiles, those are high. Hard commodities, you've got steel prices, you've got scrap prices that are high. And then you've got the industrial metals, which, copper is really the proxy right now. So as you talk about the issue of, construction, you've got lumber prices that are up over $1,000 a board foot. You've got copper prices that are exceptionally high. Input costs for construction are high. And then, on the other side, like I said, you've got soft and agricultural commodities are high too. You talk about soybeans and corn and even hogs to some extent. You've got a lot of these things moving in this direction. You can see going back over multiple years, 2010. We're really packing a lot of data points here consecutively of really strong growth in commodity prices. In fact, it's from an investment standpoint, the index is really on a tear, which this headline kind of implies. But I think the other thing that's implicit in this is that you've got input costs that are going up that, as I've been talking about for months now, are eventually going to have to be passed through to the consumer. And just one manifestation of this whole supply chain issue is the used car value index. And this is essentially a price proxy for used vehicles. Because the supply of new vehicles has been challenged, you see used prices going up through the roof. So in bridging the gap between this inflation pressure, commodity price pressure into the fixed income market, I wanted to show the break-even rate for the U.S. 10-year Treasury. And this is essentially the difference between the TIPS rate of Treasury inflation-protected securities and the actual 10-year yield in the marketplace. And so the difference is commonly known as this inflation break-even rate, or the 10-year break-even rate. And so this is the bond market's interpretation of inflation over the next 10 years. And so you can see here that we've really come a long way where we thought that we were going to have a lot of disinflation or benign inflation. We've seen these commodity prices really take off, and we've seen these other input costs. We know, at some point we're probably going to have, because of the tight labor pool that we're seeing now with a lot of job shortages in cases, even though with a higher employment rate, you would expect employment costs to move higher. So all of this is playing into this number here. And as you can see, you've got to go back to 2013 before you can find a break-even implied inflation rate as high as what we have right now. 2.5% is still below the long-term average of 3%, dating back perhaps 50 to 60 years. But it's well above what we've seen lately, and it's actually contributing to this notion that we're going to have perhaps a Federal Reserve rate hike by the end of perhaps 2022, early 2023. Something else to consider here too is I thought this was interesting. So foreign purchases of U.S. Treasury bonds have been not terribly strong over a period of several years, but basically in this last year, we've seen a real drop off in the amount of interest from foreign purchasers of Treasury bonds. And so, what does this mean? So you have net sellers around the world of U.S. Treasuries, and so what that's doing on the one hand is it's putting pressure on U.S. financial institutions to increase their holdings of treasuries. And we know the Fed is repurchasing treasuries, and then they're essentially holding a large part of the new issue. But the other thing too is when you decrease the demand for U.S. treasuries, it increases, kind of intuitively increases the supply, and increased supply and less demand tends to depress prices, which in this case tends to inflate yields. And so the read through on this is that you have the impetus behind more yield expansion particularly for treasury bonds, and I think then through into the corporate space, and yield spreads are really low right now, and that means that there's a high degree of confidence in economic growth, and I think it's justified. But when you see things like this where foreign purchases are down, it would have that offsetting influence on rates to continue to push those higher, especially if you dovetail that with increased inflation expectations. Here's a slide on energy demand, and more specifically, it's oil. We look at the International Energy Association. Basically, we look at the EIA, which is the domestic counterpart of that, looking at U.S. numbers, and then you've got OPEC out there looking at their data. And so, in all three cases, what you're seeing is, looking at a net, really a net weakness in energy demand, really picking up next year, or this year, I should say, as we get that data at the end of this year and into 2022. The expectations that we're going to have much stronger demand, again, kind of symptomatic of an improving economy, an improving global backdrop, et cetera, which I think will help commodity prices in the energy space. Obviously will help crude to some degree. It will help natural gas as kind of a tangential benefit, but positive numbers on the demand side here. And we'll conclude on a couple of things. This one I thought was really interesting, and it seemed like it was starting to be a trend a couple of years ago, but really accelerated during the pandemic, where we saw a fairly dramatic drop-off in college enrollment, which seems to kind of fit into this narrative that you've got some folks that are entering the trades. There's a lot more emphasis on trade training. There's a lot more emphasis on having, perhaps apprenticeships and work experience on the job as a substitute to, kind of this traditional core body of knowledge approach. But I thought this was interesting because you've seen a really dramatic drop off in percentages that, frankly, we haven't seen for 20 years. And we'll conclude on this, and this is just the office space per employee. Not surprisingly, I think companies have become a little bit more, productive in the sense that, you've seen the advent of the cubicle, which I call the personal decision center. So you're able to fit more people into a smaller space. But I think the way this is going to evolve going forward, interestingly enough, is that you have this little bump in office space per employee as you're giving them more room in this post-pandemic environment. But then you'll begin to see this evolving trend that kind of got kick-started last year about working from home. And so when these numbers get revised, I think you'll continue to see this downtrend in office space that's dedicated for each employee, meaning that a lot of these folks are going to be working remotely and from home, and you're just not going to need corporate office space for these. So it'll be interesting to watch how this plays out in that sector here over the coming decade. That will do it for this week. I appreciate the time that you spent. On behalf of all my colleagues at BKA Wealth, I really appreciate your interest in this program. Welcome your comments or questions at the information you see provided. Have a safe week, have a productive week, and we look forward to seeing you again soon. Take care.